You got stuff for Halloween. All right. It looks pretty cool. This looks pretty neat. I might think about this for a gift for my wife. What's the next occasion that's coming up? So good stuff. Look at that. Good stuff. Yeah. This looks great. Okay. So I got it. So they're e-commerce. You go online, you can get, different types of gifts. And I would say that these gifts are cool. These are, a little different, not the stuff you're going to find at Walmart or Target. You can kind of get a little more creative and be a little more thoughtful in your gift giving. All right, I'm in. Now, this is e-commerce. Good. It's better than retail. I hate bad mouthing industries, but I do not like retail. So let's take a look at this guy. Okay, so we know that this is in. Let me look at one more thing. This is going to be a consumer discretionary specialty retail. And I'm going to agree with consumer discretionary, but I don't agree with it as specialty retail. I think it's more e-commerce because you're doing business with them online. So that's okay. Not a big difference in interpretation there. Really small cap, $841 million. Year to date, this thing's up 40%, 1 year, 92%. Man, teddy bears are profitable. Look at that. All right, let's keep going. So revenue, 522 million. That's not bad because you're paying less than 2 times revenue for the business. Net income, 59 million. Okay. PE ratio 14, forward P of 15, very rational. They pay a dividend, 1.36. Analysts think it's fairly priced. Now, it has been going up, and not too long ago, along with a lot of businesses, this was trading for about half of their stock price. How is that they're only up 40%? Anyway, so it's really done well since May. All right, so the revenue growth is not exciting. It's let's look at the quarterly. Quarterly looks good. Last 2 quarters, they grew by more than 11%. That is good. So they're doing something right because they keep growing year after year. Now, they're not setting any records here, but it's still growth. Looks good. So their cost of revenue isn't very high. These guys are going to have a higher margin than that technology services business we just looked at. Their gross margins are 56% to make little teddy bears and stuffed animals for people. Data is like handling data and probably hiring really expensive database administrators and so forth. And they don't make that good of margins as compared to Build-A-Bear. So Build-A-Bear is at 56. That's very good margins. We looked at Lululemon just yesterday, or maybe the day before, and they had margins in this neighborhood. So good margins. Profit margins, 11%. That's decent. Their free cash flow, they're not showing anything for the trailing 12 months. They have cash flowed every year. Okay. Now, what's interesting is the cash flow did come down a bit, and they don't have a lot of cash flow, but the cash flow did come down. Maybe they're growing their materials. You know what it might be is they probably import a lot of their materials that, like the stuffing and the actual little animals are probably being made in China. They get shipped to the US unstuffed, and then they probably stuff and stitch them, final stitching as the customer orders them. So if the tariffs affected Build-A-Bear, that those tariffs may be squeezing out some of that profit and cash away from this business. That's a theory that I'm creating on the fly. So that might be the case there. So I'll go with free cash flow of, I'm going to average the last 2 years, 46 and 28 is going to be 74. And that means that when I divide by 2, I'm going to get $37 million when I average the last 2 years. That's what I'll go with on the free cash flow forecast. So gross margins were good. All right. I want to check out their debt. Let's see if they have debt. So total debt is 107 million, cash on hand 39 million. So they have 68 million dollars of net debt. I don't know if that's a ton. I don't think it is. I think their size, I think that's okay. So 39.11 in cash and then 107 million dollars in debt. When we go to debt to EBITDA, 0.75. If it's under 3, that means it's a good balance sheet. If it's over 3, it's a risky balance sheet. And we are in the low risk, range of this particular balance sheet. 5 analysts cover Build-A-Bear. One analyst believes it's an $85 price target stock, and one analyst is way down here at 39. On average, or consensus, is that it's discounted just a little bit by 3%. So you have a fiscal year that ends February 1st. That's typical of retail or e-tail. And they are in the year that's going to end February 1, 2026. They're expecting to continue to grow. That looks good. It's good to see a business grow year after year. And these guys are growing year after year. They're not setting any records, but it's good to see the growth. And the earnings per share is expanding year after year. So that looks good. I'm going to use the $4.22, which is next year's, because we're already well into the current year. And when we do these forecasts, we're assuming we're starting today and looking forward 12 months. So if I do that, I go into the new fiscal year by a very good amount. So I'd rather use next year's and look forward. The earnings per share is growing a little bit, and then it's going to grow more in fiscal year 28. And then the year following, it's going to grow nicely. So I'll grow it by about 10%. Let's take a look at how many shares are outstanding. And they have 13 million shares outstanding. All right, so let's go back to my valuation schedule. Make a little more room here, and we will put Build-A-Bear in here. So Build-A-Bear is small. They have a decent balance sheet, but they are really small. So I'm going to go with the 9% discount rate. The free cash flow that I wanted to go with was the average of the last 2 years. That is $37 million. And they are growing mid-single digits. So I'll go 7% on the first 4 years and then 4% on long-term growth. That gives us an intrinsic value of $745 million. Now let me add cash and take away debt. The cash balance was 39 million, and the debt on the balance sheet was 107. So that brings that number down to 677. Shares outstanding were 13 million shares outstanding. So based on cash, on a starting point, which was an average of the last 2 years, if I forecasted using that as a starting point, I'm not seeing a discount. I'm actually seeing that the stock price is 20% too high compared to cash flows or the value of cash. The earnings per share was $4.22. And the PE ratio, this is not a glamorous, really sought after industry. So they are growing a little bit. So I'm going to go with a 16 PE with a growth rate of 10%. So in general, this stock is being sold at a slight premium of 8%. Now that's not kind of out of the question because it's been going up in value. For year to date, it's up 40%, 1 year, 92. I mean, at some point, this stock is, got expensive or is fairly priced. But It's not like it's been sold off and wow, it's highly discounted. No, I think it's priced a little bit at a premium, and I'm not sure this is going to keep working. Um, I don't see why not, but it's not like there's a big story or theme behind the success at Build a Bear. I think they put out a nice product. Looking at their website, looks really neat, but it's not a stock that's offering the investor a big discount. It's actually saying, "Hey, investor, if you'd like to invest in this company, you'll have to pay 8% above the intrinsic value of the cash flows and the earnings per share." Sebastian, thanks so much for being a member. And I hope you found my research interesting. This will be posted on the member repository. I'll be updating that probably next weekend. In the meantime, just let me know if you have more questions on it.